Series of educational webinars designed to enlighten you on a variety of trading ideas and concepts. Today's session, the hidden market signals predicting what happens next. On any given day, a stock price can close higher or lower or unchanged. And when the closing price is above the previous day's close, then that stock is said to be advancing. If the close is below, then declining, and exactly the same unchanged. Advance and decline data is referred to as the internal breadth of the stock market. And cumulative breadth internals can confirm, alert, and warn of general health of the broader market trends. Now, although breadth can be analyzed by numerous parameters, for instance, advance and declines, number of highs and lows, percentage of stocks above a tactical moving average, their overall purpose is to measure whether there is enough internal data to predict and or support that the current trend and conditions will continue, or offer clues that that trend and control could be changing momentum and direction from within. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist, and think of market breadth analysis as the check engine light on your dashboard. It could be something as simple as an oils change to something more serious. Market breadth analysis is simply a form of assessing risk, interpreting what the real market strength or weakness looks like, and to anticipate when markets are at risk, allowing traders and investors to rebalance, profit take, add risk protection, as well as finding the confidence to do nothing at all and just ride the trend in control. So stick around as I show you how to interpretate the market's dashboard and how to use the wide variety of the internal market data that Barchart provides. Now, before we get to that, please welcome Barchart's project director and our moderator, Jean Baker. Hello, Jean.
Happy Wednesday, John.
Happy hump day to you. We were just laughing that our comrades in Chicago are digging out of the snow, and you and I down here in the Mid-South are enjoying some nice winter-like weather, right?
Cool. Yeah. If I have to be out of town, better when it snows there and not here.
Yeah, exactly. So anyhow, so we're going to get to market breadth today, something that I know some folks maybe not know a lot about, but certainly is something that they should know about, okay?
And you are going to tell us all about it, I'm sure.
Well, we're going to try in the hour that we have together. Okay. Just to remind everybody that today's session is for educational purposes only. And let me do this. Buying, selling any commodities or stocks or other investments are best made on the advice of qualified financial professionals, and under no circumstances shall we be liable for any losses that you incur or based on any information or trading activity that you engage on based on any information or material that you receive through Barchart and our services. Okay. So let's get this guy going. Okay. So, there are multiple ways to analyze the market breadth, and each of them has a specific purpose, a distinct interpretation, and a correlation of confidence when analyzing trend. So for instance, advance and decline issues and volumes, that's something that we can check every day. And it gives us a quick read of the underlying demand of the broader, let's say, accumulation versus distribution. In other words, buying versus selling. In advanced decline, divergences often are the first technical sign before a trend reversal. Now, example would be when the index makes, let's say, a new high, but the AD, the advanced decline, favors declines. More stocks fell than rally. So your breadth is weak and narrow, and your trend is at risk. Now, we're going to look at a majority of these and how Barchart not only provides information on these, but I'm going to show you ways how to interpret that data and a checklist of importance and priority. But we're going to look at the 200-day moving average. We're going to look at new highs and lows over multiple time frames. Number of stocks above tactical moving averages. We'll look at market cap, largest versus small, and what that means, that leadership, what that could mean to us. Cap weighting versus equal weighted performance. Again, are we seeing too few stocks representing the greater market? And then something called volatility breadth, which in general terms just is there a general health to our trend, and our breadth analysis, are they in concert or in contradiction? All right, so we need to have a checklist to start this examination of market breadth. And so one of the easiest or simplest and one of the highest of priority to give us a good understanding of the big picture health and determining if long-term trend integrity will be looking at the number of stocks above the 200-day moving average. Now, what we're going to look for is weekly trends in that percentage. Is it rising? Is it rolling over? Or is it falling? So in theory, well, first of all, before we go to the bar chart site, we also want to think about checking sectors, individual sectors in that 200-day breadth. Which sectors have, let's say, 60% of those stocks in that sector above the 200-day versus, let's say, 30%. And that could give us a general indication of market strength. And then we're going to look into the identifying the sector health rotation from a 1 month ago. Again, who has been our leaders and who is leading now. So in theory, first of all, let's go into Barchart, and I'm going to go to what is called the market under stocks, the market performance page. And if I scroll down here, what we can see is not only do we get the index itself, but the different sectors, and we can see how many stocks are above the 200-day moving average. Now, in theory, if we're above, let's say 50 to 60, that is healthy, that is bullish, right? If we're below 50, let's say into the 30s, then that would be bearish. But we also want to be aware of trend. In other words, we're going to look at these values and see, is this percentage rising? Is it falling? Or is it rolling over? Now, we also want to be aware of extremes. For instance, if we get 80% above the 200-day movings, that could be exuberance or telling us we might be near a top. Or if we get below, let's say, 20%, that could be a capitulation bottom. So one of the things that I'm going to show you throughout today's session is I'm going to show you some kind of hidden charts in some very unique bar chart symbolism. And so if I click on this 58, 200-day moving average 58 on the S&P index, that is going to take me to a chart. Now, a lot of times when you go to one of these charts, the first time you go to the chart, you might just see single data points, dot points, excuse me. And what you might want to do is a kind of a little trick here is you might want to come in here on your chart and change that to a line chart, and that will connect all the dots for, make it a lot easier for you to visualize it. But this one's okay. with the open, high, and low close for now. We'll talk about that. The other thing that we're going to do is, we can look at this data and, it's kind of random, right? It's all over the place, right? And there's a lot of noise in this. So what we want to do is we want to detrend this. In other words, what we want to do is we kind of want to smooth it out over a period of time. So one of the things that we can do is we can come back into our indicators here and then type in just the word moving average and then add a moving average. Now, if I'm going to look at the number of stocks above their 200-day moving average, I don't really care what happens on a day-to-day basis. I really kind of want to look at this over a certain period of time. Now, depending on what type of trader you are or how you want to define market breadth, but I want to kind of look at, let's say, what is that value over, let's say, a month period or 20 trading days. And that's what I've done here. I've added a moving average of 20. And so what I can do then is, and here you can see it's already, I have it turned off for the moment, is we can turn that on and bingo. Now what we see is that randomness, that noise is smoothed out for us. And so what we can do at this point is to eliminate that noise, we can just turn it off up here on this little eyeball here. And now what I see is a very clear trend of our 200-day moving average. And so what I look here as I see is, for instance, since about December of 2023, we had a majority of stocks that were above their 200-day moving average. Now the blue line here, I drew that in for market demonstration, and that is the 50% line. So again, above 50, healthy, bullish, below 50, not healthy, bearish. But you can see that from about, about January of 24 to December of 24 for 1 year, we were held in a very strong position. And so that to me would be a sign of strong breadth. In other words, probably the market was trending. Now, what we do see here is that about, December or January, the breadth started to change, that less and less stocks were above the 200-day moving average. Now, that's not necessarily a concern, but the fact that it happened very rapidly could be a sign of us that something is happening to our larger trend. But we're still above 50 and we're still in that kind of that 50-60 range. But then we fall quickly again back towards the 50 and then below the 50. And so this would be a confirmation that now our breadth is weak. So what can we do? Well, what we can do is we can come back in here where it says compare, and I'm going to add the index. And notice that we do give you some preset indexes. You can compare versus another stock or maybe another market. But here I'm going to use the S&P index. And I've already done that. And I have it currently turned off by this little eyeball, and I'm going to turn that on. And this is where we're going to start that breadth process. Again, notice how above 50, right? That is confirming to us that we're in a nice, strong uptrend. What we want to be concerned about is when the market starts to make new highs, but our breadth is falling. This is called divergence. This is a negative divergence. And so at this point, that's telling us that our trend is potentially at risk. Now, again, here we can see where we were bouncing between the 50 and 60 level. That is not danger, but is concern, right? And that might be a time for us to start adding some risk parameters. In other words, maybe buy some puts, take some profits, maybe even rotate from some of my winners into some other sectors. But certainly we can see as our breadth indicator fell below 50, that would have been a good sign for us to do some type of profit taking. And a confirmation that our uptrend at that point was now over. Now, what is interesting, if you look at recent market activity, again, notice that we're well above the 50. We've been kind of bouncing around that 60, and the market is continuing to move higher. But what has happened of recent? The market had made new all-time highs while our breadth was weakening. Now, again, health-wise, right, still kind of slightly bullish, right, slightly healthy. We're still above 50. But again, this could be a sign for us that we might want to do some time of risk assessment, risk adjustment, or even portfolio uh, rebalancing. So what's the takeaway here? Well, large divergences between our index prices and these longer term breadth models precede nearly every major market correction. All right, so the next one we're going to look at is the 52-week highs and lows. And so I'm going to go back into uh, where it says stocks, and I'm going to look under the one that says stock momentum. And what we want to kind of do here is notice that we do give you a number of new highs and lows over multiple time frames. And again, this process we kind of want to do is, as you become more familiar with this breadth idea, is we want to watch the number of new highs versus the number of new lows to get kind of a determination of health of our trend. Now, I want to start at the 52-week, the bigger picture process. And so what we want to do is we want to make sure that we have more stocks are making new 52-week highs than making 52-week lows as the market is going higher. Now, we can see for today, for instance, and this NYSE, is that we have 74 stocks that are making a new 52-week high and only 6 that are making new 52-week lows. That is a positive breadth. But again, we got to look at this in a proper perspective. There's 1,800 stocks in this database, and it only represents 4%. So we can look at it as a total number, or we can look at it as a percentage. In this case, yeah, we're seeing almost a 10-to-1 new highs versus new lows. That is a good value, but in terms of percentage, it's very low. Now, if it was like something like 600 were making new highs and only 60 were making new lows, a 10-to-1 ratio, that would be a very positive breadth. So we can look at it in terms of absolutes, or we can look at it in terms of percentages. So what we want to look for is surges of new highs, especially early in bull markets, and that would be a strong conviction or a strong confirmation. We want to also be aware of expanding new lows. This could tell us that our market is at stress and warns of trend breakdown. So again, right here it says details. If I click on this is going to send us to this special symbol page. And this where we can look at a lot of different highs and low comparisons. Overall, NYSE, NASDAQ. And, the NASDAQ is kind of in the headlines, right? What's going on with, all these AI stocks. So let's do this. Let's go down and look at this special symbol, 52-week highs minus the lows. Again, what we want to kind of see is what is the trend? What has been going on this particular breadth indicator? Now, I like to do this when I'm doing the 52-week highs. I like to do this analysis in the weekly time frame, but you could do it in the daily. And again, my data points here were dots, and I change it to a line. And again, a lot of randomness, right? A lot of up and down. The red line I drew for demonstration purposes is the value of 0, which means an equal amount of highs and lows. But again, we want to kind of do this measurement over a certain period of time. In other words, we want to kind of detrend this. And so one of the indicators that we talked about is a moving average. And this one I'm going to do is I'm going to look at 1 week's, our data point, versus 1 month. Well, 1 month is what? 4 weeks. So I'm going to put a 4-week moving average here. And I have it already loaded up and I've turned it off by this eyeball and I'm going to turn it back on. Again, a lot of noise, a little noise here to look at. So let's do this. Let's turn off our 1 week data point, and what we can see is our 52-week number of new 52-week highs versus number of 52-week lows. That balance in terms of breadth. And again, what we want to look for is not only positive breadth, but that transition where we go from, positive to negative. And so what we can do is, again, if we look at, for instance, what has happened since about June, more stocks have been making 52-week highs, but as of recent, again, a little bit of a sell-off. And I see over here, right, more stocks were making 52-week highs, but here we see we fell below. So that would be more negative breadth. So again, I can come back, go to a comparison, turn on the NASDAQ, right? There it is, NASDAQ composite, and do that analysis. And this is what we want to look for, these divergences. Here we can see the NASDAQ is making new all-time highs. What is our breadth? Our breadth has fallen. Our breadth has turned negative. This is warning us that the condition of this trend is at risk. Notice that recently, right? Market was making all-time highs. Right as we made all-time highs, our breadth turned negative. That is telling us that more stocks were falling, even though the index itself was rising. So that would put us at risk. All right, the next thing on our checklist that we're going to look for is something going back to our advance and declines. Again, that is found on our market momentum page, and this kind of gives us a perspective on a daily level. But again, what we want to kind of do on this one is we want to look at, again, those 52-week highs and lows. We want to look at shares. That's our volume, our breadth volume, and our issues would be the number of individual stocks. Now, on any given day, what you're going to see is the market's going to range somewhere between 45 and 55 between the advancing and declines, or 40, 60, something like that. When we get above, let's say 70, 80, or even 90, that could be a very strong indication of breadth, either advancing or declining. Now we want to be aware of extremes, 9 to 1s, 90s, 9 versus 1, 90% versus 10%. Those usually are moments where the market has either exuberance or maybe some type of capitulation. And they could be counter trend indicators. But you can see today we're about 70, 30. Here we got 65, 35. So a slight bullish breadth. Again, we look at this on a daily basis, but again, we can look at this over a period of time. And how do we do that? Well, we go to this hidden screen, details, and we're going to look at advance and declines, in this case by exchanges. Now, if you're not familiar with Amex, that is the American Stock Exchange, and American Stock Exchange was the predecessor of the S&P. So let's look at the advances and decline ratio. There it is, right here, ADRA. And let's open up that chart. And this is, we're going to take that value of number of advancing issues versus declining issues. And, again, look at our stats here. Very, very random, right? A lot of noise. So what we got to do is we got to detrend this. So in this one, I'll do the daily, but I want to look at what has happened on, let's say, a weekly basis, 5 trading days, or a 2-week basis. And that's what I have here. I have a 10-day moving average. And let's turn that on. And again, I can turn off the noise. And what do we see? Well, again, in terms of advances and declines. So we can see that from about, going all the way back to August here, we have a positive breadth. In other words, more advances than declines for a long period of time, all the way until we get to about October, right? First time of maybe a little bit of breadth weakness, but certainly here we can see it rolling over at the end of October. Well, let's see what the actual S&P did during that time. And again, I can do that through the comparison. And I'm going to turn it back on. And there you go. Positive advanced decline, up trending market. Now, this was a little bit of an anomaly. Remember, that was literally like a one-day event. But this is what we're looking for, right? Market is making new highs while our advanced declines are turning negative. That is a warning sign to us that we need to manage our risk. Now, what is kind of interesting here is in recent days, or in the intermediate, is that we have seen what is called a breadth thrust. In other words, a lot more advancings than declinings, and we can certainly see that represented by our price action of our index itself. So in the intermediate, we are starting to see a lot of positive breadth to the market. So let's talk about intermediates. So I want to go to market performance page. And when I talk about intermediates, I'm talking about the 50-day and the 100-day moving average. Now, I tend to like the 50-day. I think this is a very valuable moving average. I think a lot of institutionals look at it. And so what we want to do, again, what is the internals telling us at the 50-day or the intermediate? And again, if we look at our sectors and our index, how many are above 50? How many are above 60? And we can certainly see, energies, 80% is above the 50-day moving average. Financials, healthcare, right? Even materials is above 65%. So in the intermediate, these are very strong sectors. The index itself, okay, only about 55%. Again, could we look at that from a moving average perspective, right? Well, what has it been doing? It has been narrowing or been falling, but just recently has gotten back above 50. So that is a positive that whatever has happened in the past has now ended. But let's look at, I think what is kind of interesting on this one is we look at materials here, right? 69% of the stocks that are in the materials sector are above the 50-day moving average. But if we look at it from the long term, the health of this trend, well, it's only 42% above the 200 days. So what we're seeing here in the intermediate is a positive breadth that could be telling us that we might start seeing a positive price action. And so we're going to look for rising breadth at the intermediate again, rising above the 50%, that is bullish breadth expansion. If we're at 40 or below, that's negative or bearish um, breadth compression. And what we're going to look for also is what we're going to call is thrusts, market thrusts. We're going to look at clusters of, percentages, let's say at 30%, 50%, and then 70%. And when we jump from 30 to 50 and 50 to 70, or 70 to 50 and 50 down to 30, this is going to identify momentum. And typically, major moves, especially upside major moves, follow one of these thrust conditions. So let's go to that chart. And again, notice that, back in the summer here, literally back early in July, every stock in the materials sector was above its 50-day moving average. But what happened? We fell very quickly from a very strong market breadth above 70 to 50, and from 50 down to 30. Now we've been in the 30s for a while now, a lot of negative breadth, which would probably translate to a downtrend. But what have we got in the last couple days? Literally in the last 5 days, a thrust of breadth from the 30 cluster above the 50 to above the 70, a very bullish indication. So how can we confirm that? Again, the XLB is the ETF for the material sector. So let's turn that on. And what do we see? Well, again, stock price falls as we have negative breadth, but notice how we've got this big thrust, positive breadth, which could be telling us that there is a sector rotation into materials, and that this downtrend that we have seen since July has been broken as the market starts to move up. Again, one of these breadth thrusts, when we move from one of these clusters from 30 to 50 or 50 to 70, is a very bullish indication that you're about to see a confirmation in your price action. Okay. So let's go down our checklist here. We talked about 52-week lows. When we're looking at those numbers, right? When we're looking at the number values, when we get into, let's say, new lows of greater than 100, that is internal damage. Again, we talked about surging new highs and looking at a 4-week period, advanced decline. We just talked about that. Our internal intermediate breadth analysis. And so let's talk about market caps and this style or leadership. So can we look at, small caps versus large cap performance? Now, leadership often shifts from a run of macro regime changes. In other words, a change in, let's say, what the Fed is doing, quantitative easing to quantitative tightening, or vice versa, or, economic indicators, right? For instance, the jobs market, right? Those types of things can influence market cap leadership. And certainly if we look at historicals, small cap stocks tend to lead us out of bear market bottoms. When we are in trend, when we were in a uptrending market, then the larger caps or the mega caps tend to carry that bullish trend. But we can also look at this from the lens of, let's say, growth versus value. For instance, value for at least for the last decade has underperformed growth as technology has advanced at a very rapid rate. But historically, though, value tends to outperform. But let's think about this from a breadth lens. Growth represents risk on, value represents risk off. And so we could think about our breadth in terms of leadership, in terms of, is the market taking on risk or is it looking for value? And so if we think about what's going on with materials, and when we do a performance, we're going to look in the second here, sector performance, what we might start to discover is, yeah, our breadth is widening, but it's going to more of value or defensive. It's not a negative, it just means that that's what the market is desiring at this moment in time. So we'll look at leadership rotations, let's say over a 2-week period. Has it changed? Are we making new number of highs or lows versus, let's say, a 4-week, right? Are we seeing a change in that leadership? So that brings us to that sector leadership idea, comparing sector relative strength and looking for emerging and then fading leadership. Again, I like to look at this on a 1-month performance versus a 3-month performance. So let's do that. Okay. Let's go back to market performance. And this is what this chart is. And this here is each of our sectors' performance. It gives it to you on a 1-year basis. And you can see here, right, the black here represents the S&P. And if we look at the performance over the last year, there's only 2 sectors that have been outperforming the whole index, and that would be communication services and technology. So that has been our leadership, right? Those are the stocks that have been leading the market. But what has happened in the last 3 months and what has happened in the last month? So let's look at 3 months. So in the last 3 months, we can see that, you know, our communication services and tech still leading, but what we see is now is healthcare has come into the picture, as well as utilities. Both healthcare and utilities in terms of sectors are more value or defensive. So what we might be seeing is a little bit of a rotation out of those. Now, if we go down to the last month, notice how our tech now has fallen below the S&P, but communication services is still outperforming the S&P, and again, our healthcare. Now, what's is interesting about communication services, and this is the importance of looking at, is this a widespread breadth or is this a narrowing breadth? And if we go into the communication services sector alone, what we'll discover is it's really it's really 2 stocks. It's Google and what's going on with Warner Brothers or Discovery. So let's go to performance here and let's look over the last 3 months. And yeah, see, it's really the breadth of this particular sector is really very narrow, and it's only 2 stocks, Discovery and Apple. And look at, again, look at our breadth at our intermediate, right? Below 40, down around 40. So this is a bad breadth, narrowing breadth indication, which tells you that you probably, if you were in this space or you owned one of these 2 stocks, this might be a time for you to do a little bit of profit taking, or at least rotating some of that out of, let's say, a Google and into the ones that are now starting to take leadership, those healthcare, utilities, even we saw in the case of materials. All right. equal weight versus cap weight. And again, we're going to look at this in a weekly view. So what we want to kind of do is we want to look at is the equal weight, in other words, the index that weights all the constituents equally versus that high concentration what we see in, let's say, in the index of the S&P. Like if you don't know, for instance, that the top 10 holdings currently in the S&P, top 10 stocks based on cap weight, represent 40% of the S&P. That's a very high concentration. As long as the equal weight can keep up with the cap weight, that is a strong breath. But we're going to look for those divergences. We're going to look for when the cap weight underperforms or maybe outperforms versus our cap weight. And so let's do this. I'm going to go to a watch list that I created. And in this watch list, I have the S&P index. I have the S&P equal weight. I have the NASDAQ equal weight, and I have the NASDAQ. So I want to look at this at on a weekly level. You know, dailies I'm not really that concerned about. Really weekly, and this is what we want to look for, right? Notice how our S&P is rallying, right? Nice uptrend, right? Making a lot of new highs at the same time. So is our equal weight. But notice here, right around October 6th, right? This is a red candle, right? We made a new high and the market backed off. Again, we made a new all-time high and the market backed off. But the following 3 weeks, the market went higher. Not only did it go higher in the S&P index, but we made a new all-time high. What did our equal weight do? Well, it did not make a new all-time high. This is a sign of narrowing breadth. And we know that because we know that what has been carrying the market, Apple, NVIDIA, Microsoft, right? Just a handful of stocks has been pulling the market up. And this is a sign of narrowing breadth. Not necessarily the market is going to crash, just telling us that our trend could be at risk if any one of those very concentrated small amount of stocks stubs their toe. And we saw that, right? NVIDIA stubbed its toe, Meta stubs its toe, and then the market fell. Now, what is interesting since then is we are now attempting to take out the all-time highs, both on the equal weight and our cap weight. And we've already seen that. We've already started doing that analysis, right? We're seeing that intermediate strength widening throughout multiple sectors. And that is a good sign for us that maybe, just maybe, what we're going to see here is a new leg up in the market. But what we want to see here is both the S&P and the equal weight participate in this rally. That would be a sign of strong breath throughout the whole market. All right. Excuse me, I got a little frog in my throat. All right. Let's go back to our slides. Okay. All right, so let's kind of put this together now. So we have all these different things on our checklist, right? So we have our 200-day moving average, right? This is a very high correlation or confidence of determining structure or trend health. New highs. Are we making new highs at the 52-week? Are we making new highs, more new highs at the 6-month, the 3-month, 1 month, right? We're going to look for early warning signs. In other words, again, if we're making new 52-week highs, but then we're starting to see, you know, we just, you know, 2 weeks ago, we made a new 52-week high, but all of a sudden, you know, we'll see a lot of stocks at the 1 month or at the 3-month level are making more new lows. That could be a warning sign to us, right? So we want to use this as a confirmation, but also that warning sign. And again, we can look at percentage over the short term, 20-day moving average, intermediate, 50 to 100-day, And we're going to look for those momentum thrusts, right? Those clusters when we move from, let's say, 30 to 50 and 50 to 70, or vice versa. And that could tell us trend shifts. Advanced declines, we can do that on a daily basis. Again, that is something that's going to have a high correlation in confidence, but it's really going to help us determine, is the market accumulating, in other words, buying, or is it distributing, in other words, selling. Market cap leadership, again, what is our risk appetite? Sector rotation, again, that macro context, right? What is driving the market? For the last year and a half, it's been the narrative of AI. What could drive the market higher? Well, that could be looking for value. That could be looking for those companies that have price control or have pricing power if we move into, let's say, a recessionary period. And where is that leadership? Is that leadership changing or is it transitioning? And that could be defined by our equal weight and our cap weight. We want to make sure that they are supporting each other and not having those tactical divergence. Breadth volatility compression. So what does this mean? Well, this is really kind of all of these kind of wrapped up together. Are we seeing our trend being confirmed, or our breadth indicators are in concert, or are they in contradiction to what our trend is doing? And then something called thrust. So I kind of mentioned this a little bit in the intermediate breadth analysis, thrust and technical indicators. Now this one is more for timing purposes, and also, again, probably a little bit more for supportive. So let's do this. So let me show you how you can do that one. First of all, I'm going to change my time frame here from weekly for this assessment. I'm going to go back to daily. And let's talk about thrust first. So let's go into indicator. And there's a couple of indicators out there I think that we can use, and we're going to use standalone studies. And the first one is right here where it says breadth thrust indicator. And let's add that. And so how you read this one is we're going to look for opportunities. What we want to see is a quick change from, let's say, a negative to a positive. And the theory here is we're going to use a thrust above 60 or 0.60 here as a buy signal, but only after it has come from a thrust to the downside below 40. So again, let me repeat that. A buy signal when we get above 60 after a thrust to the downside. Now, if we go back in time here, there have been multiple. Here's one here where we got below 40 and we got that thrust. That would have been a buy indication. Here is one here as well. And again, just recently, right? So right now, the thrust indicator is kind of neutral to us, not really helping us. The other one we can look at is something called McClellan oscillator. And excuse me, standalone. There it is. And if some of you might be familiar with this one is part of what is called the Hindenburg omen. And again, this is kind of just tells us momentum. Anything that is green, that's kind of telling us we have positive breadth. Anything that is in the red is telling we have a negative breadth. And again, what I really kind of want to look for is divergences. Again, look what's going on here. Here we can see the market is rising up. We have positive breadth, right? That's right here. But the market then makes a new all-time high. But at that moment, our McClellan indicator has turned negative. That is a warning sign to us. Again, what is current conditions, right? Well, we're kind of just neutral, right? Neutral. So the market is trying to figure this out. What we would really love to see is if we do make a new all-time high, we really want to see that McClellan indicator get back into the green. Okay, and the other one is technical indicators. Some of you have been come to a lot of my sessions. I like to look at ADX, relative strength index, and MACDs. And so again, we kind of want to look for those divergences. So here's a template I use. This is the 20-day moving average, exponential moving average. This is a 50-day exponential moving average. Again, that kind of that intermediate short term. Are we above or below as a confirmation or contradiction? But the ADX tells us the strength of our trend. And so what do we see here? As we're making new all-time highs, what is the black line? Our ADX was falling. So if you're not familiar with ADX is, basically the ADX line above 20 is telling you that you have a trend. It doesn't necessarily mean a positive or negative. It could be above 20 and be a downtrend, but in this case, above 20 would have been an uptrend. Below 20 tells you that you have no trend. So you can see our ADX here is telling us that we are basically trendless. The DI positive and DI negatives, positive being green and red being negative, can tell us if there is a change, and above 25 would be a sign that we are starting to change back to a positive market breadth. RSIs, again, this is kind of like your speedometer of your car. It's telling you how fast is the market moving in the direction of your trend. So what is happening here is market is trending higher, making new higher highs, but our RSI is diverging, right? It's not confirming these new highs. It's making lower highs. This is called negative divergence. This is a warning sign that this trend is starting to lose momentum. Now, recently we have come back above 50. That is positive. But if we are going to get above the new all-time highs, we really would like to see the RSI take out the 60 and get closer to what would be considered overbought in the 70 condition. But again, notice this. We made this all-time high, and what did our RSI do from that moment, right? It was negative. All right, so that's a way you can look at in a very short term, looking at for thrusts and market indicators. All right, Gene, so let me do this, and then we'll look at some takeaways. I do see some questions that are coming through. So let me take a moment here, okay?
Sure, John, while you take a moment to look at the questions that have come in, just want to remind everybody that most of what John is showing you today is available with a free Barchart membership. Now, he's right now on his screen, he has a watch list open with grid charts showing a 1x2 grid. That will require a Barchart Plus or Premier membership in order to use that special feature. I would certainly recommend that you take us up on our free 30-day trial if you have not tried Plus or Premier, just so you can test out those grid charts and see how you can easily do comparisons like John is doing here. Okay, back to you, John.
Thanks, Gene. Yeah, I think that's real important understanding. Also, there's other things like, Gene, maybe you can talk about this is, for instance, when we go to like some of these special symbols or special charts, if I'm a regular subscriber and I've already set those moving averages, or I've changed my chart from those data points to lines, then those are saved for me as well, right? Correct, Gene?
Well, as a free member, you can set up one template, chart template. So if you always want to show your chart as a line chart, you can certainly do that, set up a template that way, along with, right now you have the ADX and RSI, along with a couple moving averages on your charts. You can set up one chart template as a free member. Again, if you upgrade to Plus or Premier, you get a whole lot more, not just in chart templates, but in the ability to analyze different data in different ways. Did I explain that okay, Jen?
I think so. That's exactly what
All
I was
right,
saying. The benefit is that I don't need to have to reset my chart every time when I become a subscription member, right?
that's correct, yeah.
Okay. I see a lot of positive comments. Thank you very much, Dorothy, Robert, a couple other folks in here. Appreciate it. I'm glad you guys are getting something out of this. This is really the purpose of these Wednesday webinars. But Robert asked an interesting question. He says, I'm a conservative investor that thinks the market is overvalued. Robert, I agree with you. I feel the same way. But I'm waiting for the market to pull back, and the market is making all-time highs. I have FOMO. Any thoughts for me? So, Robert, we do a show on Fridays. It's called Market and Close, which I would recommend that you would watch. But then last week, we talked about this idea that the market was in a correction or potential in a correction. You're looking for a buying opportunity, right? So, if you're a long-term investor and you're just going to buy the index itself, right? That is fine, right? Maybe you can deal with overvaluation over a longer period of time, right? Because you're in it for a long period of time. But we looked at, again, we looked at the equal weight. And this is here's the equal weight of the NASDAQ, right? And so, it did have a correction, right? Now, how do you define a correction? 5%, 8%, 10%? Well, this fell about what? About 8%, right? That would have been a buying opportunity. And what we talked about in that session was, let's look for those stocks that have fallen to or come near to their 200-day moving average, or, and you can see here the equal weight, right, come near its 200-day moving average, or find where we had recent support, which was some June lows. Now the index here, the equal weight index, is showing that, right? The cap weight is not. That is because of that narrow concentration. But what I could do is I could go to any stock, right? Any different stock. Let me go in. Let's say the one we were kind of looking at was Meta, right? And we were saying, hey, was Meta a buying opportunity? Well, let's look at it from that perspective. Well, it's still below its 200-day moving average. So maybe that is not a buying opportunity. But if we look at, say, let me think about this for a second, of recent, right? Right, Google has been on a tear, but recently, right, not too long ago, right? Did it have a correction? Did it have, a pullback or breakout above its 200-day? This is not a good example here, but what I'm saying is, Robert, there are a lot of stocks in a lot of the indexes in those sectors. For instance, let's go in material, let's go in healthcare, that I'm thinking about. Regeneron, there it is, in the healthcare space, which did have a pullback, did have that buying opportunity based on, right, breaking out above the 200-day moving average. That would be a positive sign. So there, you need to do your homework. You need to look beyond the indexes, look in the sectors, look in that leadership, look for those stocks that are exhibiting those conditions that we wanted to look for. So I know that was a long answer there, but I think that hopefully you'll get something out of that, Robert. Okay. John B. says, show us the best way to translate this data or others on your site to successful stock day. Again, I think this is a good way. I kind of talked about this in the beginning. Breadth analysis is really more about a larger picture, a larger assessment of risk, So we want to be in the market when we have a positive breath, when we have positive um, conditions. Again, if I went into the material space, I could find a lot of stocks that are exhibiting positive momentum. I could do that analysis. That would be a great way to take advantage of what I'm seeing internally based on market breadth, right? So if we go into um, the material space, one of the things I kind of just do is here I'm going to go to materials. I know that this has been a weak sector, but it's now starting to show strength, right? So I'll go into the stocks that are in that sector. I'll look at the performance. Okay, we know that we want to see what one stocks have been outperforming over, let's say, the last 1 month or the last 3 months, right? And you can see where we can find that. Looks like steel, um, um, Newmont. That's following the gold movement. Uh, this stock is in a lot of different. It's in refineries. It's in chemicals, energy storage, right? And a lot of narratives that are very positive. Plastics, right? And again, if we look at this in terms of a chart, right? I'm probably a very positive looking chart. So here's the outperformer in the sector that is now performing based on breadth, right? That's a great way to how you can do stock picking. Okay. All right. I see a lot of other questions. If I don't get to your questions, I apologize. We are a little bit over here. I want to finish up. Send those questions to support@barchart.com and we'll get those answers for you. Okay. So let's talk about breadth regime. Again, bullish expansion. We want to see that 20-day, the 200-day moving average. We want to see that rising, that trend, a new highs expanding, broad sector leadership, small cap, especially at the beginning of a new move. Bullish but narrowing, right? We have a good or okay 200-day, but our 50 is weakening, right? Typically bullish, but narrowing is mega cat love. We saw that recently. And our sector leadership is narrowing. A bearish deterioration, new lows expanding, very negative or bearish 50-day breath, sector rotations into more defensive. And again, our equal weight is underperforming our index. Bearish capitulation, bottoming, that could be found by an extended cluster, right, of a lot of new lows over multiple time frames. But look for this condition where you get one of those advanced decline days where you get 90% to the down and then immediately followed, not necessarily the next day, it doesn't have to be, but let's say within a week's time, you get a 90% up day. That is a very good sign that you've probably put in a near-term bottom. Small caps tend to outperform very strongly at one of these capitulation bottoms, and look for those breath thrust conditions that I showed you. All right, so final thoughts here. Breath signals are real. Take them seriously. They just don't happen right away, right? The risk still remains. Using your breath as a collaboration, not as a sole entry or exit, right? Look at other metrics, technical, macro, and sediment based. A breath behavior may vary depending on whether the market is in a secular bull, which we had just recently been in, a narrowing cap rally, which again, I think is more likely where we were just at, and that rotation inside of our sectors. And then breadth checklist keeps you in tune to market internals. If you get one of them that changes, that might just be an anomaly. Two, an offset. You get three or more, that is your warning. And I showed you at least 4 warnings that during our last peak top. And it takes a long time for an ocean liner to turn around. And bull markets are difficult to kill. So market breadth internals are evidence of change in regime, but they are not a timing tool. Better for using for risk management. Okay, guys. A little bit over. Apologize for that. I hope that you guys enjoyed today's session. Until next time, best of health, manage your risk, and the good of all trading.